Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Terima kasih kerana menghadiri sidang akhbar pagi ini mengenai prestasi ekonomi negara pada suku pertama tahun 2022 dan juga perkembangan monetary dan kewangan. With me today, I have the Chief Statistician, Datuk Seri Dr. Muhammad Uzair Mahidin. As you know, DOSM is the formal agency that compiles and publishes the KDNK statistics or GDP statistics for the country. So, in the first quarter of 2022, the global economic recovery moderated as the reopening of economies was weighed by developments surrounding the military conflict in Ukraine and lockdowns in China. So these factors led to lower economic activity among the emerging market economies towards the end of the quarter. Meanwhile, inflation rose higher, driven by further increases in energy prices amid ongoing geopolitical tensions and re-escalation of supply chain disruptions. Nevertheless, trade activity remained resilient despite rising headwinds. Regional economies saw continued strength in exports of goods, especially among commodity producers. So let me now hand over the presentation to Datuk Sri Dr. Uzair to announce our GDP performance for the first quarter this year.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh and a very good morning. Yang Magia Tan Sri Governor, ladies and gentlemen. In the first quarter, the Malaysia economy grew by 5%, supported by the expansion in domestic demand, the recovery in the labour market, and continued strength in external demand. On seasonal adjusted quarter-on-quarter basis, GDP expanded at a strong pace of 3.9%. On supply side, the overall expansion was mainly driven by the services and manufacturing sectors. The services sector grew at a faster pace, supported by higher leisure-related spending, business-related activities, including professional services and transport and storage amid the reopening of the economy. The manufacturing sector was supported by the continued demand for semiconductors and consumer-related products such as motor vehicle. The agriculture sector registered a smaller expansion as all farm output was temporarily disrupted by heavy rainfall in the early part of the year. Meanwhile, the mining sector remained in contraction as output was weighed down by maintenance closures in several oil and gas facilities. And finally, construction sector contracted at a slower pace with improvement in non-residential activities and continued implementation of small-scale projects. Now I move on the demand side. The overall performance was supported by higher growth in consumption and improvement in investment activities. Private consumption grew at a faster pace, driven primarily by recovery in employment and income condition. In particular, spending on necessities and selected discretionary items such as restaurant and hotel and recreational services expanded further during the quarter. Private investment registered a positive growth underpinned by continued robust expansion in machinery equipment (M&E) investment and smaller contraction in structure investment. Public investment contracted at a smaller pace during the quarter, reflecting mainly improvement in general government fixed asset spending. Public consumption expanded further, driven by higher spending in supply and services amid support from COVID-19 related expenditure. Net export moderated as growth of import outpaced that of export amid strong domestic demand. The current account of the balance of payment narrowed to RM 3.3 billion or 0.7% of GDP, mainly on account of the lower goods surplus as import grew at a faster pace. The current account surplus in the first quarter of 2022 was mainly supported by net export of goods. The goods account registered net export of RM 40.5 billion compared to RM 51.8 billion in the fourth quarter last year. Meanwhile, the primary income account recorded a deficit of RM 20.1 billion as compared to RM 19.6 billion in the previous quarter amid continued investment income accrued to foreign investors in Malaysia. In the financial account, net FDI inflows improved to RM 24.4 billion from RM 0.7 billion in the previous quarter. This was driven by higher inflows from equity and investment fund share and debt instrument. These investments were channeled primarily into the manufacturing sector and the financial services and wholesale and retail subsector. Before I hand over the floor to the Governor of the Negara, I'm pleased to inform everyone our three new release publication is on the GDP and also this one on the balance of payment as well on the IAP can be obtained from the DOSM portal at www.dosm.gov.my. Thank you. Hand over to you, Tan Sri Governor.
Thank you, Datuk Sri Dr. Uze. So moving on, the labour market has shown continued improvements as economic activity resumed. The recovery in the first quarter was supported by improving employment. Jobless claims fell and rehiring of retrenched workers continued to improve. Data from SOCSO also indicated a continued decline in layoffs and relatively strong hiring activity in the first quarter. Private sector nominal wages grew by 4.7%, supported by increases in both the manufacturing and services sector wages. Going forward, further improvement in the labour market is expected, which will be key in supporting the economy. So the first quarter growth performance and latest indicators show that growth is on a firmer footing. As shared during the bank's EMR release in March, we still expect the Malaysian economy this year to expand within the 5.3 to 6.3% range, driven by higher domestic demand and support from external demand. This is given the normalization in economic activity, especially with the reopening of international borders and, importantly, improving labour market conditions. There are upside potential to the growth outlook. This could come from better than expected employment and income conditions that will support household spending and stronger recovery in tourism-related sectors. However, uncertainties surrounding the outlook remain, particularly from external factors, including prolonged supply chain disruptions amid military conflict in Ukraine and lockdowns in China. Headline inflation moderated to 2.2% in the first quarter, as expected. This was due mainly to the dissipating base effect from lower domestic retail fuel prices last year and the absence of base effect from electricity tariff rebates implemented in 2020. In line with expectations, core inflation increased to 1.7% during the quarter, reflecting price adjustments after a period of subdued prices amid the high-cost environment and improving demand. Correspondingly, price increases were more broad-based during the quarter. Nevertheless, the CPI items with above-average inflation rates are largely reflected by supply-driven factors. For 2022, headline inflation is expected to average between 2.2% and 3.2% for the year. Core inflation is expected to average higher between 2 and 3% in 2022, reflecting the improvement in economic activity and continued cost pressures. The inflation outlook, however, continues to be subject to global commodity price developments arising mainly from the ongoing military conflict in Ukraine and the prolonged supply-related disruptions as well as domestic policy measures on administered prices. Household inflation expectations remain anchored, as indicated by the narrower spread between longer term and short term expectations in the first quarter this year. Analysts' inflation expectations for 2022 are also within the bank's forecast range. Long-term expectations, captured by the average over 2023 to 2027, remain anchored close to the actual historical average inflation. So during the COVID-19 crisis, the OPR was reduced to a historical low of 1.75% to lend support to the economy. The unprecedented conditions that warranted the significant monetary support then have since abated. So if you recall in the last press conference and also in my forward for the EMR 2021 that was released on the 30th March, I mentioned that adjustments to the OPR would mean that we are sure of a firmer growth trajectory. Indeed, we are seeing more evidence of growth being on a firmer footing amid the strengthening of domestic demand, better labour market conditions, and improved investment activity and prospects. As such, the MPC decided on Wednesday to begin reducing the degree of monetary accommodation by raising the OPR to 2%. The adjustments will be made in a measured and gradual manner. Most importantly, I wish to emphasize that our stance remains that monetary policy will continue to be accommodative to support a sustainable economic growth in an environment of price stability. Global financial market conditions have tightened. This reflected a further rise in the expected path of central bank policy rates in many advanced economies, increased investor risk aversion to the conflict in Ukraine, and expectations for slower global growth momentum, including in China. These developments had also affected regional financial markets to varying degrees, depending on countries' exposure to commodities and their major trade partners. In Malaysia, year to date, the 10-year government bond yields increased by 84 basis points, in tandem with the upward adjustment in global bond yields, and the ringgit has depreciated by 4.7% against the US dollar amid broad US dollar strength. Malaysia's equity market performance declined marginally, reflecting increased investor risk aversion and slower global growth. Going forward, as a small open economy, shifts in global liquidity and financial market conditions will continue to have a bearing on domestic financial markets. Nevertheless, we expect external spillovers to domestic financial intermediation to remain contained due to the bigger role of domestic and ringgit-based financing, the presence of well-capitalized banking sector, and greater FX risk management capacity in the onshore market. This will ensure that financing continues to support the economic recovery. In addition, Malaysia's external position remains resilient against external shocks. This is supported by one, a sustained current account surplus, secondly, Malaysia's net creditor status, and thirdly, adequate international reserves. Notwithstanding these important external buffers, the bank continues to remain vigilant of the risk from disorderly financial market adjustments, and we stand ready to utilize our wide array of instruments in addressing any excessive volatility so that financial intermediation remains uninterrupted. Net financing grew by 4.5% as at the end of the first quarter. Outstanding household loan growth increased to 4.8%, with higher growth recorded across most loan purposes. Growth in loan disbursements remained robust amid forthcoming loan demand. Loan repayments also recorded higher growth. For businesses, working capital loan disbursements continue to record strong positive growth during the quarter. Outstanding investment loan growth also improved, reflecting growth in the SME segment. Financing by banks continued to support MSME businesses, with outstanding financing to this segment expanding faster at a 6% pace year-on-year as at March this year. During the first quarter of 2022, disbursements and repayments continued on a strong momentum from the previous quarter, sustaining at levels much higher than pre-pandemic levels. By sector, disbursements for MSMEs have been forthcoming across major MSME sectors. The increase in the first quarter was mainly in the manufacturing sector and specifically wholesale and retail trade and restaurants and hotel under the services sector. Despite elevated credit risk in the current environment, the banking system remains well positioned to support household and business financing needs as the economy recovers. Banks continue to maintain prudent provisioning practices to account for higher credit risks. Further additions to provisions are likely to be more modest given the sizable buffers already built up and continued support for more vulnerable borrowers. This is also supported by healthy liquidity and capital buffers to absorb potential losses and preserve the lending capacity of banks. So let me now conclude the briefing. Growth expanded by 5% in the first quarter of 2022, driven by domestic demand amid further recovery in labour market conditions as economic activity resumed with the easing of containment measures. Growth for the year will continue to be supported by private sector spending amid the reopening of international borders and recovery in labour market conditions. Headline inflation for 2022 as a whole is expected to average between 2.2% and 3.2%, while core inflation would trend higher to average between 2 to 3%, reflecting improvement in economic activity amid higher costs. In the meantime, targeted policy measures and assistance will continue to provide support to vulnerable businesses and households. So I have come to the end of the presentation. Thank you.